Hey everyone, if you watch the morning news, you've probably heard the dollar is strong a lot lately. Most people shrug and think, okay, the buck is up. Dig a little deeper, and that phrase means far more. The foreign exchange market is the biggest market on earth, roughly $8 trillion a day. When you wire money overseas, buy European stocks, or book a trip abroad, the price you pay is set in this market. Today we'll unpack why exchange rates rise and fall, the real mechanics with charts. We'll learn together while watching the US dollar index daily chart on your screen. An exchange rate is simple. Think of swapping $1,000 into euros at the airport before a trip. Institutions do that same trade every day at enormous scale. The price all those trades produce is the exchange rate. It's a supply and demand price. Example, a US exporter that earns euros still needs dollars to pay workers at home, so it sells euros and buys dollars. A European investor who wants us to pay 500 dividends in euros creates demand for euros instead. That balance sets the rate. The dollar index daily chart on screen is exactly that tug-of-war over time. Moves higher mean the market needed more dollars. Moves lower mean the dollar was in relatively ample supply. To get rate differentials, start with bank interest. If a US online savings account pays around 4% while similar deposits in Europe or Japan pay far less, where would a large investor park cash? In the United States, for the higher yield. That surge in demand to hold dollars is textbook. When Fed policy rates sit above rates abroad, it becomes one of the strongest signals pulling capital into the dollar and lifting the dollar index. Watch today's DXY chart and you'll see that rate gap effect written into the price. The stronger the dollar, the weaker many other currencies look by comparison. US high rates acting as a magnet for global capital show up directly as a rising dollar index on this chart. When US companies sell aircraft, software, or farm goods abroad, dollars often flow back home. More dollar supply can put downward pressure on the exchange rate. That's the trade balance channel. Heavy exports tend to support the home currency. Heavy imports lean the other way. Over long horizons, purchasing power parity, PPP, also matters. The idea, the same basket of goods should cost roughly the same across countries. If a Big Mac is about $5 in the US and much cheaper or pricier overseas, currencies tend to drift toward levels that close that gap. Historically, after exchange rates swing to extremes, they often mean revert toward that kind of fair value baseline. Check the long-run path yourself on this weekly chart. In the end, FX is a composite of rates, trade, investor psychology, and geopolitical risk. No single factor alone decides the move. Look at the dollar index daily chart on screen. At the right edge, you can see, intuitively, how far price sits above longer-run averages, a picture of a relatively strong dollar regime.
Why?
First, a global hunt for U.S. assets. Pension funds and individual investors worldwide have poured into U.S. stocks and treasuries, which means persistent demand to buy dollars. Second, elevated Fed rates keep pulling foreign capital toward the United States. Those two forces together built the trend you see on the chart. Track how each factor shifts from here, and judging the dollar's next chapter gets much easier. To measure how strong the dollar is in one number, traders watch the DXY, the US dollar index. The chart on screen compares the dollar against a basket of 6 major currencies: the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc. The index is centered around a base of 100. When DXY sits above that baseline, the dollar is historically firm. Below it, relatively soft. Use the chart in front of you and judge for yourself where we are now. When DXY rises, the dollar is strengthening and many emerging market currencies weaken by comparison. Check this index daily, and you can read which way global investors are rotating capital across currencies. To sum up, an exchange rate is the price created by the mix of rate differentials, trade balances, investor psychology, and geopolitical risk. It is rare for any one factor alone to set the rate. Track the dollar index daily chart on your screen together with major currency pairs, and you'll start to see which currency's global capital is flowing into. When you invest abroad or think about currency hedging, this becomes your most basic decision tool. Disclaimer: this lesson is for education only and is not a recommendation to trade. Currency trading and international investing carry a risk of loss of principal. Learn thoroughly, judge carefully, and only decide what fits your own financial situation. Thank you.